market, and how do we get an efficient market, right? What are the things we need to do to make sure the market is efficient? Now, first of all, why do we need it? It's obvious, right? So that people who want to save are able to save, people who want to borrow are able to borrow, people who want to manage their risk get access to derivative contracts that can help them manage their risk, right? Trading of cash for commodities, and commodities can be bought and sold basically easily, so trading is possible. So this entire system helps the global economy function. It's very, very important. How do you get that, right? What do you have to ensure? What are the characteristics that you need? Number one, everything that we have discussed, the people borrowing, lending, managing risk, trading, should be able to do what they need to do, and they should be able to do it in an efficient way, which is not just operationally efficient but also informationally efficient. Now that is something which will be discussed in a lot more detail when we talk about market efficiency. There's a whole learning module for market efficiency, but I'll just give you a sneak preview. See, operational efficiency basically means the bid-ask spreads should be low, right? So that the cost of trading is low. When you place a market order, let's say, it should not only be executed immediately, it should be executed at good prices. Otherwise, the impact cost will be very high, right? The bid that you might have or the ask that you might have there might be a huge difference between the two. Secondly, what's really important is this informationally efficient component, where we don't want an unfair market, that some people have inside information and they're making a lot of money and other people are actually not making that money. So at their expense, some people are making a lot of money. So that means we don't want any kind of unfair stuff, right? It has to be fair, and if anybody is doing insider trading or anything like that, that has to be stopped. And that's not the only type of fraud that can go on in financial markets. You could have accounting fraud, right? So that's why you have accounting standards, to make sure people don't try and deceive their investors and try and run off with their money. So this is what the government and the regulatory agencies try to do, that they try to have good accounting standards, they try to monitor the trading so that there is no insider trading going on. Also, whoever are the intermediaries in terms of brokers, dealers, banks, insurance companies, etc., fund managers, they should have advisors, they should have a certain qualification criteria, minimum standards for them, to make sure that they are not just competent but also the agent is acting in the best interest of the principal, right? So otherwise there will be the principal agent problem, which is an agency problem. Also, we don't want companies to go down, right? Otherwise, if they default, then their investors will lose their money. So we don't want them making too many risky investments, especially if they don't have the money to do that, right? And if they're making very long-term investments, well, those investments should be funded by long-term bonds or equity instead of short-term. So the matching should be there in terms of what is the maturity duration of the investment versus what is the type of financing that is being used to finance that investment. So, of course, this has been a beast of a reading, very, very big, and you will be able to fill color in all these different areas that we've talked about as you study fixed income as well, apart from equity, as you study derivatives, as you study alternative investments, right? And of course, as you further your studies within the equity section, because all of them are going to definitely be part of your financial system. They are a part of your financial system. So to be able to understand the entire financial system, you have to understand that there's stocks, there's bonds, there's contracts, and there's real assets that are there. And people save not just in banks but in stocks as well. People borrow not just from banks but also by selling bonds, right? Companies sell bonds, they can even sell stocks. There's an IPO, there's stock markets in the middle, there's brokers in the middle. Then the derivative contracts come in that help you manage the risk, and that's not only for financial assets, it can be for physical assets as well, future deliveries. I gave you the example of Emirates and oil. There's of course speculators and active traders who are trying to come in and use public information right, public material information, or even if they are using some private information, then it is non-material, right? Otherwise, of course, insider trading is a big problem. You're not allowed to use private material information. All right, next, three main functions. Of course, inside this first one, there are six, which we just discussed. And then there is two more, that the equilibrium rate. So the borrowers and lenders come together in the financial market and they're able to decide what is the rate and who gets the capital. So automatically it is allocated to the best users. Right? We talked about all the different types of assets and contracts that we have. There's financial assets, real assets. Financial assets include stocks and bonds. Real assets are like real estate, commodities, etc. You can classify investments into debt and equity. So equity is going to be stocks, debt will be bonds, and shorter term fixed income instruments like T-bills, commercial papers, right, which comes in money market. These can be traded on the stock exchanges or publicly traded. They can be private as well. So equity can also be private, debt can also be private. You can have on the spot trading, which is usually T+2, sometimes T+3, sometimes T+1, but mostly T+2. And forward is for future delivery. That can be done through various different types of derivative contracts, which will be studied in a lot more detail when we get to derivatives, right? You can have derivative contracts for both financial assets and physical assets as well. When the issue is being done for the first time, the company which is issuing the securities, whether they are stock or bond, and they're doing it initially for the first time, that's called a primary market transaction. The investment bank helps them out over here. When investors are buying and selling with each other, that's a secondary market transaction. If the security is giving you your money back within a year, the maturity is less than 1 year or less, that's a money market instrument. And if it is more, then it's a capital market. Of course, stocks are all capital market because they don't have a maturity. Traditional includes stocks, bonds, and cash, and stocks is long only. If you're doing long short, that is a hedge fund, right? If you're doing private equity, again, hedge fund. So private capital is private capital is alternative investment. Hedge funds are alternative investment. Long only stocks, cash, and debt are traditional. Commodities also alternative. Real estate also alternative. Precious gems also alternative, and will be discussed in a lot more detail when we get to alternative investments. Right. So of course there are lots of different types of securities. Fixed income such as bonds will be discussed in more detail in fixed income. There is equity investments, that is common stock, preferred stock, and of course you can have your options, which issued by the own company is called warrants. Then there is pooled investments such as mutual funds, right, ETFs, etc. So we looked at all of that. Then we had a look at your derivatives, which of course will be discussed in a lot more detail when we get to derivatives. We give you a little bit of a sneak preview into that what are futures, forwards. Futures are standardized, forwards are customized. Swap can be various types. Fixed interest rate for a floating interest rate, that's called a plain vanilla interest rate swap. You can have an equity swap that you pay a fixed rate and you get the equity return of an index. You can have options as well. So all of this will be looked at in a lot more detail when you get to derivatives. Of course, some contracts are cash settled, such as your contracts for differences. No physical delivery takes place in the future for these. We talked a little bit about currencies, commodities, and real assets. Again, this will be covered in a lot more detail when you get to alternative investments. Right, we talked about who are brokers. They try to connect a buyer and a seller. At the same time, they make a commission, whereas dealers would use their own money if the buyer is coming first or the seller is coming first, and then they would buy from the seller and then wait for a buyer to come, and then they might even make a profit on this, right? Investment banks help the issuers do your primary market transactions, such as selling stock, which could be common or preferred, or selling bonds. Exchanges is where the secondary market transactions will happen once the investors want to meet each other and exchange assets. Alternative trading systems such as your dark venues, your dark pools, where you can hide your identity, and your pre-trade orders. Depository institutions are banks or some special type of banks, such as savings and loan bank, etc. Right? Insurance companies, of course, life insurance, auto insurance, and all the different types of insurance that you have. Clearinghouse or custody companies, depositories where you would like to. This clearinghouse is like future exchanges, right? Discussed in a lot more detail at derivatives, and custodies can be kept with specialized custodians if you don't want to keep your securities with your broker. Right, long position, short position. Long makes money when it goes up, short borrows the asset, sells it, and tries to buy it back at a lower price to make money, and short benefits when the asset price goes down. This is very, very important. So in the whole reading, I think the most important thing is this formula. You need to remember it. This formula, the leverage ratio, I think it's just intuitive, right? Asset divided by equity. And this is the same as financial leverage from FSA. So that I don't think you should remember. You should just know that. Margin call, this is a formula you have to remember. And this entire calculation is relatively straightforward. The only thing you need to make sure you don't forget is that the buying commission is included in the original investment, and the selling commission is subtracted from the sales proceeds. Right, we talked about all the different types of orders and the execution instructions. So we talked about market orders. The good thing about them is they get executed immediately, but the price could be very bad, especially if it's a thinly traded stock. Limit order, the good thing is that the price is fixed, but execution is not guaranteed. All or nothing means either the entire order will be filled or cancelled. Hidden orders, you place a little bit, you tell your broker and then they place a little bit, but it's not hidden from your broker, so that's a bit risky, especially because of front running. Iceberg order, you're hiding the whole order yourself, you're only placing a little bit. Day orders will be cancelled at the end of the day. Good till cancel, remain open forever. Immediate or cancel or fill or kill, which means it will be immediately filled or cancelled. Good on close, which means this is used by funds, mutual funds, open-ended mutual funds usually, right? Because they want to trade as close to end of day prices as possible, because their NAV is going to be end of day prices. So they want the trading to be as close to that. So those orders will be active on the close to the market closing time. And stop orders, we talked about this, buy stop, sell stop. This is for stop loss. Right, clearing instructions will tell you where the broker should put where they should take the money from, which account, and where they should put your securities for custody. And we talked about the advantages and disadvantages of market order. Executes quickly, but price is not guaranteed. The price is predetermined, but execution is not guaranteed. It might be partially filled or not filled at all. Primary markets, where the issue is being done for the first time, or even if it's a secondary issue, the issuer is getting money, right? The whole point of a primary market is that the issuer is getting money. Wherein secondary markets is just one investor selling to the other. And if you don't want to offer to the public, you could offer to the private placement as well, which is lower cost, but the rate that you get for your security which you're selling might be lower than what you could get in a public market. Stock markets are order driven. We talked about that. Market order, limit order. Your forex market is quote driven, where the big players will quote what is the bid and ask they're offering for a certain currency. Brokered markets are very common for real estate, but also for bonds, where the broker would try and connect a buyer with a seller. Then we talked about the well-functioning market characteristics, right? So you want the market to be able to help people achieve their goals, whether somebody wants to save or borrow or manage their risk, right, or just trade. The market should be able to help them do that in an operationally efficient way and in an informationally efficient way. That means it should be fair, right? There should be no insider trading, there should be no fraud, there should be no accounting fraud. Disclosure should be as true as possible, and it should be basically fair for everybody. Right, so we don't want any kind of fraud. We want a certain bar, a high bar. We want to set a high bar for the people who are in this financial market, such as analysts, such as yourself, or one that is training to be one, and advisors, brokers, dealers, bankers. I mean, you name it, right? I mean, everybody who's involved in this has to have a certain qualification, and they need to have certain licenses to make sure that they act in the best interest of their principal instead of themselves. Otherwise, that is called a principal agent problem. It should be fair. Nobody should have an extraordinary advantage. The company should not be doing risky investments, especially if they are undercapitalized. Otherwise, they could lose their money, and it's not their money that they will lose, it's the investors. So we want to protect the investors, right? And long-term investments should be funded by long-term liabilities, and they should have enough money to pay back those liabilities so that the investors are protected from loss.